On behalf of Edelweiss Securities, I welcome you all for Adani Ports and SEZ Q3 and 9M FY21 earnings call. From the management today, we have with us Mr. Karan Adani, CEO and whole-time director, Mr. Deepak Maheshwari, CFO and head of strategy, and Mr. D. Balasubramaniam, who is the IR head of Adani Group. Without further ado, I would now hand over the call to Mr. Karan Adani for his opening remarks, which will be followed by Mr. Deepak Maheshwari's remarks, and then we will open the floor for Q&A. Over to you, Karan. Thank you.
Hello, sir. Good evening, ladies and gentlemen. Welcome to the conference call to discuss Qtr3 FY21 operational and financial performance of Adani Port and SEZ Limited. Hope all of you are doing well, keeping safe, and continue to take necessary precautions. Q3 of FY21 was a period of reset at multiple levels. A ravaging pandemic, a stuttering economy, and unsettling future prospects were concerns during the first quarter. The business and economy have recovered strongly as a balance was reached between life and livelihood discussion. The rollout of a successful vaccine invented in record time will further bring in balance. Coming to the key highlights of operational performance in Q3 FY21, APSEZ handled cargo volumes of 76 million metric tons, a growth of 37% as against 7% growth registered by all India ports. This includes 10 million metric tons of cargo handled by Krishnapatnam Port, which was acquired in October 2020. In Q3 FY21, on a year-on-year basis, APSEZ overall market share in all India cargo volume has increased from 22% to 28%. Similarly, market share in all India container segment has also increased from 36% to 43%. This is on account of enhanced capacity and acquisition of Krishnapatnam Port. Our cargo basket continues to be diversified with bulk constituting 44% of our cargo, container 42% and liquid cargo including crude which constitutes 14% of total cargo. You may refer to our operational and financial highlights presentation for port and cargo segment-wise breakup. Let me take you through cargo volume performance segment-wise. In container business for Q3 FY21, APSEZ handled a total container volume of 2.06 million TEUs, which is a growth of 36%. Mundra Port continues to handle the highest container volume in India and is now the premier container port in India. It has for the third quarter in a row surpassed volume handled by JNPT. Mundra Port in Q3 FY21 handled 1.59 million TEUs compared to 1.29 million TEUs handled by JNPT. 5 new container services were added across Mundra, Hazira and Kattupalli ports, which will add another 340,000 TEUs of container volume on an annualized basis. Dry bulk as a segment registered a growth of 42%, which was led by coal that grew by 51% and fertilizer which grew by 134%. In Q3 FY21, total cargo handled in this segment was 37 million metric tons. During Q3 FY21, we have signed 5 new contracts at Dhamra Port to handle various cargoes including gypsum and iron ore. Dhamra Port will handle an incremental volume of 10 million metric tons on account of these contracts. In Q3 FY21, APSEZ handled liquid cargo including crude of 10 million metric tons, which is a growth of 24%. As part of our diversification, we added LPG and LNG cargo into our portfolio. In Q3 FY21, APSEZ handled 213,000 metric tons of LPG and 567,000 metric tons of LNG, a growth of 50% and 10% respectively over Q2 of FY21. Krishnapatnam Port, which was acquired in October 2020, is now part of APSEZ's consolidated operations. During this quarter, Krishnapatnam Port handled 10 million metric tons of cargo. Krishnapatnam Port on revenue of rupees 473 crores and EBITDA of rupees 336 crores in Qtr3 FY21. Ebitda margins during the period is 71% due to realignment of operations, debottlenecking, bringing in best operational practices of APSEZ. These initiatives will help the Ebitda margins of Krishnapatnam to reach 78% by FY23. Coming to logistics business, we continue to pursue our objective of bringing the customer to our port gate by integrating our logistics business and consolidating all our rail assets in Adani Logistics Limited. As you are aware, Adani Logistics currently operates 60 rakes on the Indian Railway network and puts container, auto, grain and bulk rakes under the General Purpose Wagon Investment Scheme. Adani Logistics currently operates 9 rakes under DPWIS. In our effort to expand this business, Adani Logistics will be adding another 16 rakes to its portfolio and has signed 5 long-term contracts to handle incremental cargo of 6.5 million metric tons with key customers like Bengal Energy, Adani Power, Rumta Sons and Adani Enterprises. Adani Logistics currently operates 5 logistics parks and is building 2 more logistics parks at Mundra and Nagpur, which are under various stages of development. This will further augment our effort to provide end-to-end solutions to our customers. To capture the opportunity in warehousing space, Adani Logistics is scaling up its capacities by building large format built-to-suit grade A warehousing at major locations and is in discussion with major e-commerce players for providing such solutions. Recently, Adani Port and SEZ Limited signed an MOU with Government of Gujarat to develop a multimodal logistics park and air cargo hub at Virochan Nagar, Gujarat. It will be the first of its kind facility in India and an MMSD in its true sense. Planned in approximately 1450 acres of land and involves the development of facilities that will cater to current and future logistics needs. The logistics park will have all 3 modes of connectivity, that is air, rail and road. The proposed MMLP is positioned to improve the efficiency of logistics operations of existing industries and has the potential to attract new investments in the region. Coming to key financial numbers, on the back of 37% growth in cargo volume, port revenue in Qtr3 FY21 grew by 35% and port Ebitda increased by 38% year-on-year. Our effort to optimally utilize resources helped in improving port Ebitda margins by 140 basis points to 71.7%. Going forward, we expect margins to expand further and reach our targeted levels of 72 to 73%. Our logistics business came back to the growth trajectory. In Qtr3, logistics revenue grew by 8% and Ebitda grew by 16%. This is on account of new routes started vis-a-vis Mundra to Kishangarh, Renukot to JNPT and Morbi to Varna, and discounting the routes which were not yielding optimal results. To conclude, we feel 90 to 95% of cargo recovery is almost achieved in India led by higher EXIM trade and also reflected in IIP and PMI data. While the economy in general will still be on a mean reversion trajectory, the port industry would be operating in a normal business cycle and we expect to achieve our cargo volume guidance of 245 to 250 million metric tons in FY21. Under capital management, our focus continues on judicious use of cash and ensuring adequate liquidity. As guided, we have curtailed discretionary capex in FY21 to around rupees 2,000 crores. Our business and future investments are aligned to sustainable growth with a focus on preserving the environment. Our strategy on environmental footprint seeks to address greenhouse gas emissions and waste management throughout the entire operation as we strive to continually strengthen our environmental practices and become carbon neutral by 2025. Now I request Deepak to take you through the financial numbers.
Thanks, Karan, and good evening to everyone on the call. I hope you had sufficient time to go through the detailed operational and financial presentation which has been uploaded on our website. Let me briefly take you through the key financial performance. Total operating revenue grew by 12% from rupees 3,336 crores in Q3 FY20 to rupees 3,746 crores in Q3 FY21. Port revenue has increased by 35% and revenue from logistics business has increased by 8%. Growth in operating revenue and Ebitda in Q3 FY21 were lower compared to Q3 FY20 on account of lower recognition of SEZ and port-led development income. Growth excluding Krishnapatnam Port was 20% in terms of cargo volume, 16% in port revenue, and 18% in port Ebitda. Growth in port revenue is lower than volume growth as a portion of the container business at Mundra Port is handled through our joint venture entities, and those revenues and Ebitda are not consolidated in APSEZ. APSEZ earned a foreign currency income of $141 million in Q3 FY21 and $339 million in the 9 months period ending in. Rupee appreciation over Q2 FY21 resulted in forex mark-to-market gain of rupees 206 crores in Q3 FY21 compared to a loss of rupees 145 crores in Q3 FY20. However, as you are aware, we exclude forex gain or loss while discussing our operating Ebitda. Depreciation for Q3 FY21 increased to rupees 594 crores due to the consolidation of KPCL assets during the current quarter. Interest cost was at 612 crores in Q3 FY21 compared to rupees 467 crores in Q3 FY20. The increase is mainly on account of the addition of debt due to the acquisition of KPCL. Effective income tax incidence for the quarter was 22% of PBT. During 9 months FY21, the company has generated nearly 4,200 crores of free cash from operations after adjusting for working capital changes, capex, and net interest cost. And we expect the same to be around 5,600 crores for the full year FY21. This is reflective of the superiority of the asset and its consistent ability to grow while generating cash at scale, which is true to its utility nature. In the month of January, we issued a US dollar bond of $500 million as a part of the capital management program to extend debt maturity and refinance debt well in advance of its maturity. With this issuance, the average maturity of the long-term debt has increased over 6 years. We will continue to focus on cost reduction, prudent capital management, and judicious capex deployment to ensure adequate liquidity and maintain our investment grade rating. With this, we can open the lines for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question, you may press star and 1. The first question is from the line of Mohit Kumar from DAM Capital. Please go ahead.
Good evening, sir. Congratulations on an excellent quarter and rising market share. So my first question is, sir, I want to pick your brain on the fact that while there is a container shortage in the entire world and high container prices, will this lead to reduction in volumes and thereby lesser revenues for us? How do you counter that? That's the first question. Second is, what led to the remarkably strong container volumes for the quarter and your outlook for liquid volumes for next 2 years?
Can you repeat your second question?
Sir, what led to the remarkably strong container volumes for Q3 FY21? And the related question is what is the outlook for liquid volumes for next 2 years, especially on LPG and LNG?
Okay. So to answer your first question, on the container shortage, so far we don't see that impacting the overall trade in terms of from an India perspective, because we are mainly an exempt trade country. reason why it will not affect us as a country is because what we are seeing rise in freights is not just limited to India, but globally we are seeing that. So that has been factored into the pricing when manufacturers or importers are bringing in the material. Our view is that this is a short-term phenomena. I think it's predominantly there was a disruption in Europe and US because of which the containers were not able to move, and we expect this to ease out in coming few months or quarters. The overall strong container growth is predominantly due to obviously the growth in the India market, and the second is also as we have kept explaining that we do continue to see diversion of volume from JNPT. The rail-bound cargo, which originally used to go to JNPT, that diversion continues, and predominantly the growth in the container businesses on the west coast is due to that. And on the east coast, it's predominantly the Ennore and the Ennore terminal, which was not there last year, that has added volume into our mix. So it's a new market for us. So these are the two reasons why we continue, and we do expect this strong growth to continue in Q4 as well, as we have added 5 new services across all our 3 ports. So we do expect this growth to continue in Q4 as well. Outlook on LNG and LPG. LPG, we expect volumes to be around 2.5 to 3 million in next 2 years' time, and specifically in Mundra. LNG, we expect volumes in Mundra to be around 2.5 million tons for the next 2 years. Also, end of calendar year 22, we expect Dhamra LNG also to be commissioned. So there we will see volumes adding on the LNG front as well.
Understood, sir. Thank you, sir. Best of luck. Thank you.
Thank you. The next question is from the line of Girish Achhipalle from Morgan Stanley. Please go ahead.
Thanks for the opportunity, sir. Your guidance implies that for Q4, there may not be an SEZ revenue. Is that the way to understand it? That was the first question, sir.
Yeah, that's right.
Okay. The second question I had was, you've done tremendously well at Dhamra, so congratulations. I just wanted to understand, you also added, your slide says that another 9 million metric tons. So I think this will be one of the record years for Dhamra, FY22, that is, or 21. Is there more likely customer addition over there in fiscal 22? And if you could help on Dhamra's outlook. And Kattupalli has been soft this quarter. When do you see a turnaround? That will be my last question. Thank you.
Yeah. So Dhamra, we do expect growth to continue because when we look at that hinterland and when we compare ourselves, I mean, our competition is Haldia and Paradip. So there is still a lot of headroom to grow. So I think on Dhamra there will be a continuous double-digit growth for the next 5 years. And we will be in a situation where we have to keep expanding capacity to keep up with the demand and the growth. On Kattupalli and Ennore, I think the overall region has had a subdued growth. I think what you predominantly because of auto sector. I think what you need to look at is how is our market share performing when you compare between when you take the volumes of Chennai Port and Ennore and Kattupalli together. So if you see that our market share over the last 2 quarters has been consistently increasing, and we expect that market share gain to continue in Q4 as well.
Thanks for the opportunity, sir. I wish you all the best.
Thank you. The next question is from the line of Apurva Bhatter from Jefferies. Please go ahead.
Hi, sir. Hi. Thank you for the opportunity. Just wanted to understand on our operational expenses for the quarter. So are there any one-offs, or should we expect this as a run rate for post KPCL acquisition?
Yes, this does include certain administrative, legal, and professional expenses which are relating to the KPCL acquisition. But otherwise, typically, you should expect, as we have indicated earlier, that the overall port Ebitda should be in the range of around 71 to 72% for this particular year, and which will also get reflected when you look at AP SEZ standalone. That should also continue to be in the range of around 68 to 69. Though in this particular quarter, you are seeing the number to be 68 because of certain expenses.
So could you please quantify those acquisition expenses?
So these are acquisition expenses which basically include professional fees, which are legal fees as well as M&A fees, and they would end up being in the range of around $3 million.
Okay. Got it. Just one more question. I think there was a question prior to this on the SEZ income. So I missed that part actually. Was that on it's not being included in the guidance?
Yeah, so we have not specifically provided any SEZ income guidance for this particular quarter.
Okay, and this quarter itself, it was quite low. Don't expect it to achieve last year's levels?
It's likely to be lower than last year's level. Of course, when you look at last year, it also included 484 odd crores, which was because of Dhamra LNG. So it won't be the right number to compare. You would also clearly factor in as to what kind of development you are seeing in the country. And when you look at returning back from a COVID environment, I think the volumes have increased first, but decisions for new investments, which are likely to drive the SEZ land sales income, we expect that to start happening from next year. And we don't expect much follow-up during this particular quarter.
Okay, got it. Thanks a lot.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Hi sir. Thanks for the opportunity and congrats for a good set of numbers. First question on the guidance, wherein you have mentioned around 2,000 crore capex for this year. Going ahead, what are our thoughts there? And especially we do have expansion plans on Adani Logistics. How would they be broken up into the port side as well as on the Adani Logistics side?
So I think depending on how we see next year, I think the capex should be in the range of 2,000 to 3,000 crores. Generally, logistics capex would be in the range of 500 to 600 crores, and then the balance would be on the port side.
And I presume the international expansion here is also included, right, in the number
yes,
that you have mentioned?
Yes, that is also included.
Sure, fair enough. And so, a related question to this. So, from a cash flow perspective, while 9-month performance has been decent, should we expect a similar run rate to continue going ahead as well, which means a much faster repayment of debt as well going ahead, or we will prefer to keep it for some inorganic acquisitions?
Yeah, you have answered your question. So, as we have guided that in this particular year, we are likely to have the free cash flow in the range of around 5,600 crores. The next year numbers, we do expect them to be more robust and higher than this year's number. But it's also fair to say that we have a net debt to Ebitda guidance to be in the range of 3 to 3.5, and we are likely to continue to be in that particular range. Most of our debt is pretty long-term in nature, where the average life is over 6 years, so it's unlikely that we will be able to pay it down. However, we are a growth company, and we'll continue to look for opportunities, both organic as well as inorganic, to deploy the capital. And we have pretty strong capital return requirements, which will continue to be in the range of around 16% IRR, as we have mentioned before. So as long as we keep getting those opportunities, I think we will continue to invest, and while still maintaining the overall net debt to Ebitda in the guided range.
Just one clarification there. Now, given the size and scale of the business is also growing at a much healthier pace, And given our debt to EBITDA guidance of 3.5 times, does that also mean that while we remain in that 3.5 times range, but the absolute debt number can also increase further, given the opportunities that we will eventually explore?
Absolutely.
Okay, that's helpful. Thank you.
That's a function of the overall investment opportunity landscape.
Yeah, exactly. Yeah. Fair enough. Thanks a lot and all the best.
Thank you. The next question is from the line of Prateek Kumar from Antique Stock Broking Limited. Please go ahead.
Hello. Yeah, good evening, everyone. My first question is on container segment growth. So is there, I understand large growth has come at Mundra port specifically, and that too at CT3, CT4. So is there any specific large component of transshipment volumes which are also contributing to growth, or is it completely domestic segment growing, domestic business imports growing in a very robust manner, and that is all which is contributing to growth?
So you're right that there is a certain amount of TP cargo as well. But overall, from a portfolio perspective, when we look at it, we find that the EXIM cargo as well as the TP cargo are broadly similar in numbers and percentages.
Okay, so percentage in 3Q versus let's say last year, normal year, it would have been same.
Very similar.
Okay. And with the sharp increase, in general, in the utilization at Mundra Port, are we looking for expansion at any of these terminals, in near term? We know that CT2 second terminal commissioned, but that is not doing seems much volumes.
Yeah, so we will be looking at the volume growth that we have next year. We do plan to, as you know, T2 is already commissioned, so next year utilization of T2 you will see a sharp increase. But right now for CT3, CT4 there is no plan to expand those terminals.
Right. And any update on, regarding this, there's land license issue which has been discussed about for container corporations, financial earnings, which has been delaying his stake sale. So, do we have any view on that as of now? There has been some discussions about new policy which has been.
We don't have any view. We don't have any view. Our information is as much as yours. So we don't have any view as of now.
Thanks and all the best. I'll get back to the queue.
Thank you. The next question is from the line of Ashish Shah from Centrum Broking Limited. Please go ahead.
Yeah, thank you for the opportunity. Sir, in Dhamra, we've said that we signed 5 new contracts. So these, from when do these kick in? Do they kick in immediately from the next quarter, current quarter, or they will go in a staggered manner?
No, all of them have been kicked in Q4, starting from Q4 itself, and the number that we have given is an annualized number.
Right. And so with whom are these contracts signed? Who are the customers here?
Just one second. It's mainly JSPL, JSW, Lungta.
Yeah, these are the places.
These are basically which are in our hinterland.
Sure. Got it. And what is the duration of these contracts? For how many years can we expect this 9 million tons to continue?
These are 5-year agreements.
Okay. Sure. Also, in terms of the whole Vizhinjam dispute that we are having with the authority. So there, if you can just highlight what is the incremental development there, and how much capex has been invested there, and are we continuing to invest there, or we'll probably watch out for what really happens of the issue?
No, so we continue. Our construction is in full force. Our jetty and the terminal is ready. Breakwater is still under construction. We expect the breakwater to be completed by FY22, early 23. And our construction, we are fully committed towards this project and to get it commissioned and to get it running. In terms of In terms of the capex spent, just one second. CapEx 1,400 crores has been invested in the project, and we expect the full 4,000 crores of capex to be completed by FY23.
All right. And just last one, any impact of this recent turmoil in Myanmar on our project? Is that progressing, or there are any challenges in the construction of that project?
Yeah, so far we've not faced any issues on the ground. Work is still continuing. There's not been any disruption at site or at on the construction. We are waiting and watching how the situation arises to then take an informed call. But as of now, work is going in full swing, and we expect the terminal to be commissioned by April of 2021.
And a concession framework and contract, is that rock solid irrespective of what happens at the political level there?
Yes, that's it.
Okay, sure. Thank you.
Thank you. The next question is from the line of Adani Vijay Kumar from Spark Capital. Please go ahead.
Yeah, good evening, sir. I just want to delve a little bit deeper into the container volume growth. So if I understand right, the container freight rates from the Asia to North America route, this is high because of shortage in equipment and a possible blanking of services. But despite this, the economic growth and the export requirement from these emerging markets to the Northern American region is what is driving the volumes. Is this understanding right?
So what we are seeing is growth not just in US and Europe sector, but we are seeing an all-round growth. So we are seeing trade increasing with China. We are seeing the trade with US also increasing, and Europe also. So it's an all-round growth that we are seeing. We're not seeing growth only in one sector.
Correct. So that is despite the increase in the container freight rates. Despite
that's right. That's right. Because as I said earlier, the container freight rates are not just these are not just increased for India. This phenomena is worldwide, and so this is being faced by all countries. So all importers and exporters globally are factoring this freight rate when quoting.
Sure. Right. So any specific cargo type that you can highlight which is driving this overall, growth across the globe? I mean, I read somewhere it is PP equipment, probably even electronics, because people are working from home a lot. But how sustainable is this? What are the cargo type that is driving this growth?
It's hard for us to tell right now what cargo type, but I can only tell you that the growth which is being driven is it just shows the sort of recovery which is happening in the country, and it just shows the kind of consumption as well as manufacturing growth which is happening in the hinterland and in the country. So, but it's hard to tell you what cargo type right now because we don't have that information immediately.
No problem, Karan. So one question on the overall Western hinterland cargo growth in containers. So earlier, if it grows at say 8%, of course Adani probably would grow at 2x of it. Right now, of course, we are at the Western hinterland itself is growing at double digit. That is for the month of say December and January. But on a sustainable basis, say for FY22, how much of growth is possible from the Western hinterland point of view?
I think our guidance continues that 2x growth of what the India trade growth is. So whatever is the Western region growth, the 2x of it we will continue to grow. So that guidance has not changed, even going forward.
Okay, sure. And a final question on the difference between the growth in the cargo volumes and the revenue number at say Mundra. This is to do with the revenues flowing to CT2 and CT3, which are JVs. That is the understanding, right?
Yeah, it is because of revenues flowing to CT3 and CT4, the JV. That's it.
Right. And any realization impact we have seen within Mundra's cargo between last year and this?
No, the tariff has been steady and increasing steadily, so there's no degrowth that we are seeing.
And one final question on liquid number. Though the coal numbers year-on-year for the third quarter is high because of Krishnapatnam, but liquid number is also grown. So any specific reason, and how is it likely to pan out?
So liquid has grown predominantly. Yeah, it is because of KPCL as well, because in KPCL also there is liquid. Also, we've commissioned our liquid facility in Kattupalli. So that is the second reason. And in Hazira also, our capacity has expanded. So these are the three reasons why liquid volume has increased.
Sure. A final question, if I may, since you touched upon on Kattupalli. So what are the efforts there to increase capacity or expand to other cargo types? How are the efforts and the capex panning out there?
So right now in Kattupalli, we have started our liquid facility. We are in the process of getting our environment clearance for other commodities. Right now we have environment clearance only for container and liquid. Once that environment clearance is in place, then we will start construction for bulk commodities. We expect the environment clearance to come in place by September or October of 2021.
Sure. So any guidance on capex on Kattupalli alone in the next few years?
Right. No, we are still we are working it out. We will give guidance in next board meeting. We'll give you the whole year guidance for next year, including capex and volume, everything for next year, next board meeting.
So finally, the overall US dollar debt, I presume after the recent bond issue, it should be around $3.8 billion US, if I'm not wrong, 3.8 to 3.9.
No, our US dollar debt the number doesn't change because the recent bond has been used or is being used to refinance the debt which was to come in due to be repaid at the end of Jan 22. So this US dollar bond does not change our net dollar liability at all.
Sure, got it, sir. Thank you so much and all the best, sir.
Thank you. The next question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead.
Yeah, hi. Thanks for taking my question and congrats on a great set of numbers. Sir, my question was just on the cargo volumes that we are looking at. So, of course, the cargo volume and the guidance has been quite, beating the industry norms. Just wanted to pick your brain on, we declared this monthly cargo volumes, and the cargo volumes in January were slightly lower than what they were in December and November. Now, I know I'm trying to nitpick here, but just wanted to check if some kind of seasonality, and I hope not because of some pent-up demand that we saw in Q3, which might just vanish away in Q4 and we see some kind of a drop in that. So do you see anything like that, or do you believe this the cargo volumes that we saw in Q3 and the growth that we saw is sustainable?
No, so I think what we saw in Q3 is sustainable, where that same number you will see in Q4, or similar number you will see in Q4, and that based on that we have given the guidance.
So the small drop in January was just maybe a one-off thing or a seasonality kind of thing.
Yeah.
Fair enough. Also, sir, just share what exactly, so where does our US dollar debt stand at this point of time, and how much would it be as a percentage of the overall debt profile?
Could you say that again, please?
So what would be the total US dollar debt in our books stand at this point of time, and that as a percentage of the total debt that we have on our books?
So the total US dollar debt that we have on our books is 3.4 billion. And as against that, and typically our debt between FX and rupee has been in the ratio of around 65 to 35, in the range of 65 to 35 to 70 to 30, and so that's the range in which we still continue to have all our long-term debt.
Sure. Great. Thank you so much. All have a good.
Sure.
Thank you. The next question is from the line of Ankit Panchmatia from B&K Securities India Private Limited. Please go ahead.
Yeah, hi sir. Thanks for taking my question. Sir, any clarity regarding extension at Mundra, how are we kind of pitching into the GMB, and any ideas around the same?
No, as all of you keep asking every call, and I keep replying in every call, we are working with GMB, and a policy should be out soon on extension for not just for Mundra but for all the private ports in the country. There are some discussions which are going on. There are a few proposals which are in place. I think once government has some clarity on it, we will definitely communicate to all of you. We expect the extension to be closed, this issue to be closed in next 12 to 18 months.
Right. Sir, a bit clarity would be much helpful here. So are we also pitching in for a 15 to a 20-year extension from here on? Any thoughts, or how are we kind of formulating our plans going ahead for Mundra?
No, I think, as you also looking for clarity, also we are also looking for clarity from government, and right now we have pitched in for, we are pitching in for as long as concession that they can give. We have not specified the number of years. We have just asked them to give as long as that they think is viable. I think, based on what government decides, then the investment plans for Mundra as well as for other ports can be decided. But it's too premature for me to give you any guidance or to give you any clarity on it.
True. Sir, now as we see that in the western coast ports, there is enough capacity, and going ahead, incrementally there would be additional capacities added by the ports in the vicinity. Do we ascertain any overcapacity leading to pricing power dilution? How are we seeing this market, say 1 year down the line, and how prominent would be the western coast according to you going ahead be?
So if I may ask, where are you seeing capacity addition? Because it would be good for us also to know. Because in our this thing, we are not seeing anybody adding capacity. So it would be good to know where you are seeing capacity addition.
So, sir,
on West Coast.
Yeah, so it depends on the extension received. So our competitor have already announced additional capex is already pegged around extension for the expansion, and also
this is who, Pipavav Port, or who are you talking about?
Pipavav.
Okay.
Yeah, and also PSA the phase 2 of the expansion would slowly steadily kick in. So maybe
phase 2 of expansion, they have asked for an extension. I hope you know that. The PSA has asked for an extension due to COVID. They have asked for a 5-year extension on that.
Okay.
So anyway, I think let me cut to chase over here. I think what we are seeing, to be honest, we do see in looking at the growth which is happening in the next 5 years, we will see shortage in capacity for containers actually, and we would look at expanding container capacity in Mundra, obviously, and we would look at expanding the capacity in Hazira linked with the railway line. Once the railway line comes in, we would see an expansion of container capacity in Hazira as well. We don't foresee, personally, I don't foresee that having any impact on pricing or anything, because the end of the day, it's all a factor of utilization and the growth that we are seeing. And if the trade continues to grow at 15-16% on container trade, if it continues to grow at 15-16%, we would see we would actually end up falling short of capacity in next 5 to 6 years.
Sure, so that helps. And sir, any update on the feeder route which would connect to the Palanpur? How are the capex, or how are the approvals in place?
That by the way, that capex is, that line, feeder line is already commissioned. We have our feeder line from Palanpur to Mundra has already been commissioned. So we are waiting for DFC to commission their line.
Great. Thanks for the clarity. Thank you.
Thank you. The next question is from the line of Girish Achapalya from Morgan Stanley. Please go ahead.
So thanks for the follow. Just a couple of them. I may have missed this, but if you can just update on Dighi Port, I mean, what's the status there and any capex outlay, or if you could share any details on the acquisition. And the second thing is just the other terminals. While it's not a very large focus area, but we're seeing some decent growth and also margin expand there. Obviously, I mean, it is not a focus area, but I just wanted to understand from a 3 to 5 year perspective, what kind of steady margin profile can be reached in the other port terminals as a cluster? Thanks.
Sure. So on Dighi Port, we are still awaiting Maharashtra Maritime Board approval. Once that is through, the acquisition will be completed. We expect the acquisition to be done to be completed by end of this month. Once the acquisition is done, we will come out with a detailed presentation in terms of how we are seeing the volumes for next 5 years, how we are seeing the capex, revenue, all of those things we will come. The whole strategy document we will come out with once the acquisition is done. On the terminal side, we would see a similar steady going forward. We'll see a similar margins because these terminals are running. I mean, especially Goa and Tuna are running at almost full capacity. So we would see a similar steady state volume and steady state Ebitda over there.
Thank you, sir.
Thank you. The next question is from the line of Ajinkya Bhatt from Macquarie Group. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I have a question on the port Ebitda margin. So again, port Ebitda margin has improved very well in this quarter, and you have guided for reaching 78% margin in Krishnapatnam by FY25. So my question is, can other ports as well target the 78% sort of port Ebitda margin, or do you think Krishnapatnam is going to be an outlier on that front compared to the existing or the pre-acquisition ports for you?
So I think not all ports you can benchmark at that level. I think honestly, to be on a safe side, I think most of the ports we will do, especially the big ones, which is Mundra, Hazira, Dhamra, and Krishnapatnam, and Kattupalli. On a 5-year basis, we will continue to cross 70%. And obviously, the ports which have already crossed 70%, there the margins will continue to, every year there will be a steady state increase, maybe half a basis points or 1 basis point, but not. I think overall, 50 basis points or 100 basis points. But overall, we expect port Ebitda margins to be in the range on a consolidated basis to be in the range of 72 to 73%.
So, any specific reason why Krishnapatnam will do much better than others? Is the
mainly because of pricing and the mechanization that they already have. So mainly because the tariffs are higher than others.
And you won't be able to match that in other ports, because I think one of the strategic reasons for acquiring KPCL was also that with KPCL you get control of 3 large ports on the eastern coast. Your Dhamra port is also actually bulk heavy, quite similar in cargo profile to Krishnapatnam as it is today. So is it then not possible to raise pricing across our other ports, considering that we hold so much of capacity on the eastern coast now?
No, so Dhamra has a very different hinterland than Krishnapatnam. So it won't. Krishnapatnam shares a hinterland with Ennore Port and Chennai Port and Kattupalli, and on the west coast Goa Port. Whereas Dhamra shares a hinterland with Paradeep and Haldia. So it's a two very distinct hinterland that we are talking about. So it's very hard to increase pricing just because we are controlling these 2 ports on a combination basis.
Okay, sir. And just one final question. On the warehousing part that you are planning to construct grade A warehouses, etc., is there any plan in the sense how much million square feet that you're targeting in next how many years or something of that sort? That's it from my side.
No, not right now. We don't have. We are still We are still concretizing our plan, but it is definitely a big focus area going forward in the logistics business.
Okay. Thank you. Thank you so much.
Thank you very much. We'll take the last question from the line of Swarnim Maheshwari. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, first question is on the SEZ business. So, we do understand that, a greater part of the income comes from the development and which during the COVID times was an issue. But then there is also the rental income that also, comes on a quarterly basis. Have we not seen that income in this quarter? Because that actually tends to be almost about 21 odd crore rupees on a quarterly basis.
That, Swarnim, that typically comes as the other income. So that the lease rentals is typically we have categorized them as the other income flow, and so it's plugged in within that other income number that you see.
Okay. All right. So, sir, any guidance really for FY22? Because, see, we were really looking at about, say, 700 to 800 to 1,000 crores of SEZ revenues. Now, this number in FY21 is almost negligible. So, will there be some bunching up that should happen in FY22?
FY21 in that context has been quite a unique year. So, not a lot of new capacity has been created and not a lot of new investments have been made. A lot of bunching up will surely take place, and we are in discussions with a number of counterparties who would have initiated their business this year, and some of them may start in the next year with the strong economic recovery that we have seen. We have on purpose not provided specific guidance at this point in time, and we will be in a position to provide that guidance once we have a better assessment of it. We are quite positive and bullish about it, but we don't want to put a number out here just for the SEZ income. We will be providing a comprehensive guidance for the full year FY22 as we move into the next year.
That's helpful, sir. That's helpful. Thank you. Sir, just one last question. So, in one of the questions, you did mention that the container shortage is unlikely to impact us. But I think that was really more focused on the freight side, really, or on the realization side. But can there be a physical shortage of container that could actually impact us from the volume side? That is what my specific question is.
Yeah, we don't think it will have an impact. As you have already seen, the strength of our assets always has, and it gets clearly demonstrated by the number of times that we outperform the market. And we have not seen that impacting the overall container business in India. As Karan mentioned earlier, that a lot of that, if it's a pricing impact, it's already factored in by the various manufacturers, importers, or exporters. And we continue to outperform the market, and we believe that the strength of our assets, both at Mundra as well as Ebitda, their ideal locations, the strong road and rail network connectivity that they have, provide us with a very strong moat by which we should continue to be in a position to outperform the market consistently.
Got it, sir. Thank you so much and wish you all the best.
Thank you very much. Swarnim, would you like to make any closing comments?
Yeah, I would just like to thank the management of Adani Ports for giving us the opportunity to host the call. Sir, at this point in time, would you have any closing remarks?
No, we look forward. Team is always available for any questions that anybody might still have.